Houston, 2001. Late November, past midnight, a lone accountant stares at a spreadsheet that no longer makes sense. On paper, his company is one of Wall Street's greatest success stories. Billions in profit, sky-high stock price, America's most innovative company. Fortune magazine said so, 6 years running. In reality, the cash is gone, the deals are rotten, and the phones won't stop ringing. Regulators, banks, journalists, all asking the same question. Where did the money go? He scrolls back through years of numbers, through quarterly reports he helped construct, through projections that once seemed brilliant. There it is, row 247. The first time he used a strange new rule called mark to market to turn a 20-year energy contract into instant profit. The first time his weird math turned a shaky future into a perfect present. That one decision didn't just help destroy Enron. It exposed the biggest lie on Wall Street. To understand how one accountant's weird math helped blow up a Wall Street darling, we have to go back. Back to when the rules changed. Back to when someone decided reality was negotiable. Enron didn't exist yet as a name most people knew. It was born from a merger of two natural gas pipeline companies, Houston Natural Gas and InterNorth. Boring stuff. Regulated utilities. The kind of business your grandfather understood. Dig pipes. Move gas. Charge fees. Pay dividends. Predictable. Safe. Dull. Our accountant, let's call him Michael, though the name doesn't matter because you've never heard of him, graduated from a state university in 1989, first in his family to finish college. Accounting degree. Not glamorous, but solid. His father worked in a factory. His mother was a nurse. Michael believed in rules, in numbers that added up, in systems that worked if you followed them correctly. He joined Enron in 1990, when it was still mostly a pipeline company trying to figure out what it wanted to be. The office in Houston was different from what he expected. Open floor plans. Young people everywhere, many with MBAs from places like Harvard and Wharton. They talked fast, used words like synergy and optimization and unlocking value. They dressed sharper than the accountants Michael had learned from in school. The culture was aggressive, competitive. They had a ranking system where employees were graded on a curve and the bottom performers were cut. They called it rank and yank. Everyone wanted to be in the top tier. Everyone wanted Jeff Skilling, the rising star executive who ran Enron's trading operations, to notice them. But underneath the swagger, Michael noticed something else, a hunger, not for money, though that was there too. A hunger for growth, for the numbers to go up, every quarter, every year, in a smooth, upward line that Wall Street could bet on. And that's where the problem started. Late 1990, early 1991. Michael sits in a conference room with senior finance executives. They're discussing quarterly earnings. The mood is tense. Enron is building massive new businesses. They're not just moving gas through pipes anymore. They're trading energy contracts. They're building power plants overseas. They're financing huge infrastructure projects that will take decades to pay off. But the numbers on the page look sluggish. Under traditional accounting rules, historical cost accounting, you record revenue when you actually receive it. Build a pipeline, wait for the gas to flow, record the fees as they come in month by month, year by year. Wall Street hates that. Wall Street wants growth now. Smooth earnings. Predictable results. A story they can sell to investors. We're doing incredible deals. One executive says, frustration evident. 20-year contracts, worth hundreds of millions. But we show a trickle of income each quarter. The stock isn't reflecting our real value. Michael understands the complaint. It's like building a house and only being able to claim you've made money as each brick is laid. rather than counting the contract value when you sign it. From a pure economic perspective, doesn't a signed 20-year contract have value today? That's when someone mentions the banks. Banks, it turns out, have been using something called mark-to-market accounting for their trading desks. Instead of waiting for interest payments and principal repayments to trickle in over years, they value their financial instruments based on current market prices. A bond you bought yesterday is worth whatever someone would pay for it today. Gains and losses are immediate, reflected in real time. Why should banks get modern accounting tools and we don't? Someone asks. Jeff Skilling loves the idea. He's been pushing it. Enron isn't a utility anymore, he argues. It's a trading company, a risk management company, a financial innovator. Why should they be stuck with accounting rules designed for factories and corner stores? Michael is assigned to a team that will make the case to the board, to the auditors, to the SEC. The process takes months. Late 1991 into early 1992. Michael helps assemble the documentation. He builds financial models showing how mark-to-market would apply to Enron's energy contracts. He sits in meetings with Arthur Andersen, Enron's auditor, discussing technical details. He watches lawyers draft memos full of careful language. The pitch is always the same. This isn't radical. This is just reflecting true economic value. When Enron signs a 20-year contract to deliver natural gas, that contract has present value. All they're doing is calculating that value today, rather than waiting 20 years to know what it was worth. To calculate present value, you make assumptions. You estimate future cash flows. How much money will come in each year? You pick a discount rate. What's the time value of money? You account for risk. You run the numbers through a model. Out comes a single figure. What this contract is worth today in dollars. The first time Michael runs the calculation on a real deal, he feels a strange sensation. He inputs assumptions, gas prices, delivery schedules, discount rates. Each assumption is defensible. Each one is based on market data or company forecasts. But he notices something. Change one assumption by a few percentage points, and the present value swings by tens of millions of dollars. He mentions this in a meeting. A senior executive smiles. That's why we need smart people like you, Michael, to make sure the assumptions are reasonable. Reasonable. That word will haunt him. The 30th of January 1992. The approval letter arrives from the SEC. Enron is now allowed to use mark-to-market accounting for its energy trading contracts. There's a celebration, champagne in the office, bonuses announced. People clap Michael on the back. You helped change the game, someone says. And it's true. The rules have changed. Reality no longer lives entirely in pipelines and power plants. It lives in spreadsheets, in models, in assumptions about futures that haven't happened yet. Michael feels pride, but underneath, just a whisper. How do you audit a future that hasn't arrived? The first major contract under the new rules comes fast, a 20-year agreement to supply natural gas to a utility. Under old accounting, Enron would recognize perhaps $10 a million in profit in year one as the gas actually flowed and payments arrived. Under mark-to-market, Michael builds a model. Future cash flows, year by year. Assumptions about gas prices. They'll rise slowly, following historical trends. Assumptions about delivery costs. A discount rate of 9%, reasonable for a contract with a solid counterparty. He runs the calculation. The present value of the contract, $287 million, which means Enron can book $287 million in profit. Today, this quarter. Michael stares at the number. It feels like magic, like reaching into the future and pulling dollars backward through time. He presents the model in an internal review. Senior executives nod along. The assumptions look fine, conservative even. But then someone speaks up. 9% discount rate? Aren't we Enron? Shouldn't we use 8%? We have better credit than most. Michael hesitates. That's a 1% difference. Run it. He runs it. At 8%, the present value jumps to $312 million. $25 million added with one change cell. See? The executive smiles. Let's use 8. We're being realistic about our risk profile. The deal is announced. Wall Street analysts praise Enron's earnings beat. The stock jumps 4% in a day. Michael gets a promotion. His bonus doubles. People suddenly know his name in the building. He's one of the architects of the new Enron way. The practice expands. Not just gas contracts, power plant deals, international projects. Enron is building a broadband network. Internet traffic will explode in the future, so those future revenues can be modeled, discounted, and booked today. Michael's job changes. He spends less time recording what happened and more time engineering what needs to happen. Quarterly earnings targets come down from above. The question isn't, what did we earn this quarter? It's, what number do we need, and which deals get us there? Wall Street loves it. Enron becomes Fortune's most innovative company in America. Stock price climbs from $20 to $40 to $60 per share. Employees get rich on stock options. The company's market value exceeds $60 billion at its peak. Michael buys a house. A nice one. His parents visit, and his mother cries when she sees it. Her son, the accountant, living in a place like this. But the math is changing him. At night, sometimes, he lies awake and thinks about those assumptions. Gas prices rising steadily. But what if they don't? Discount rates that assume Enron's credit is rock solid. But what if it isn't? 20-year contracts that assume counterparties will pay every year. But what if they default? During the day, though, the machine hums. More deals, more models, more profits appearing on the page. The seduction is complete when Michael realizes the fundamental truth. Mark-to-market doesn't require you to be right about the future. It only requires you to be reasonable about your assumptions today. And reasonable is negotiable. 1,997. 1,998. Enron's finance team gets more sophisticated. They create something called Special Purpose Entities, SPEs. These are separate companies, legally independent, that can hold assets and debt off of Enron's balance sheet. The technical rules are complex, but the concept is simple. If Enron wants to do a risky deal without showing the debt on its books, it creates an SPE. The SPE borrows the money. The SPE takes the risk. Enron gets to book the profit while keeping its balance sheet clean. Michael helps review some of these structures. His role is to ensure the accounting treatment is correct, and technically, it is. The rules allow for off-balance sheet entities if they meet certain criteria, but the substance is uncomfortable. Enron is showing billions in profit, while quietly parking risk in these hidden structures. When Michael looks at the consolidated financial picture, Enron plus all its SPEs, the numbers are far less impressive. Sometimes, they're alarming. He mentions this once to a colleague. The SPEs are holding a lot of our downside. His colleague shrugs. That's the point. Look, the auditors signed off. The lawyers signed off. The SEC hasn't said boo. If everyone who's supposed to check this says it's fine, then it's fine. That logic is everywhere at Enron now. If the past gatekeepers approve it, reality must comply. But Michael is starting to learn that gatekeepers have incentives too. Arthur Andersen makes $52 million a year from Enron, $27 million in consulting fees, $25 million in audit fees. Rating agencies get paid by the companies they rate. Wall Street analysts work for banks that earn fees on Enron's deals. Everyone in the system has a reason to believe the numbers. Not everyone is buying it. There's a risk manager, a woman named Sherron, who keeps asking uncomfortable questions. Where's the cash? She says in meetings, "We're showing billions in profit, but our cash flow from operations is negative. Where's the actual money?" The answer always is some version of, "This is modern finance. Profit and cash flow are different things. We're investing in growth." One afternoon, Sherron pulls Michael aside. "You build these models, right? The mark-to-market calculations?" "Yeah." "Level with me. How sensitive are they? If gas prices drop 10%, what happens to our earnings?" Michael has run those scenarios. He knows the answer. A 10% price drop could wipe out more than $1 billion in paper value. But that would mean revising the models, which would mean restating earnings, which would mean admitting the past was wrong. They're sensitive, he admits. And we never revise them downward. We haven't needed to, yet. Sherron leaves the company a few months later. Michael hears she went to a quieter job at a utility. People joke that she couldn't handle the pace of innovation. But Michael remembers the conversation. Late at night, alone with his spreadsheets, he starts keeping a private tally, a mental ledger. How much of Enron's reported earnings are based on cash that actually arrived versus cash that exists only in models? How much of their profit is real versus imagined? The ratio gets worse every quarter. 1,999, 2,000. Enron is flying high. Stock price above $80. Jeff Skilling becomes president and COO. The company's ambitions expand into everything. Weather derivatives, broadband, international power. They're not an energy company anymore. They're the world's leading company, in their own words. But inside the finance division, Michael sees the cracks. Projects that were supposed to generate cash aren't delivering. The India power plant, massively expensive to build, is facing political problems and might never operate profitably. The broadband network is burning cash with no clear path to revenue. Yet every quarter, earnings go up. How? More deals. Constantly more deals. The company has become addicted to mark-to-market. They need new contracts, new projects, new ventures to create new future value that can be booked as profit today. It's like a Ponzi scheme. Except it's not cash they need. It's optimistic assumptions. Michael is in a meeting where someone uses a phrase that makes his blood run cold. We need more deals to feed the beast. The beast. That's what the Prester quarterly earnings target has become. A creature that demands to be fed with fantasy profits or it will devour them all. Michael doesn't think much about the employees. Not at first. He's focused on the numbers, on the models, on getting through each quarter. But then he attends a company-wide meeting. It's about retirement accounts. Enron's 401k plan is heavily weighted toward Enron stock. Employees are encouraged to buy it. We're going to $100 to $150. Executives say, this is your wealth-building opportunity. Michael looks around the room. Regular people, secretaries, engineers, maintenance workers, people who saved a little from each paycheck and put it into Enron stock because management said it was smart. What they don't know, senior executives are selling. Not all at once. That would look bad. But steadily, quietly, cashing out millions in stock options at the peak. Ken Lay, the CEO, sells $70 million in stock. Jeff Skilling sells $15 million. CFO Andrew Fastow is making money from the SPEs themselves through special management arrangements. The inequality becomes visceral to Michael. The people who know the numbers are fiction are getting out. The people who believe the numbers are real are doubling down. When this collapses, who will pay? 2000 into 2001. The markets get shaky. .com bubble bursts. Enron's broadband dreams evaporate. Energy markets in California go haywire. Blackouts, political investigations, bad press. Enron's real performance is deteriorating. Projects that were modeled optimistically are coming in far below projections, which means technically, those mark-to-market values should be written down. Losses should be recognized. But that would mean admitting the past was wrong. That would mean restating earnings. That would mean the stock would plummet. So instead, they get more creative. More SPEs are created to hide losses. Mark-to-market assumptions get even more aggressive. Higher prices, lower discount, rates, longer timelines. Michael is in a closed-door meeting. Just senior finance people, no minutes taken, when someone says it out loud. If we marked some of these deals to reality instead of to our models, we'd have to recognize billions in losses. Silence. Then, so we don't. The logic has completed its terrible circle. Mark-to-market was supposed to bring economic reality to the balance sheet. Now it's being used to escape reality altogether. Michael goes home that night and opens a bottle of bourbon. He's never been much of a drinker, but tonight feels different. He's not just an accountant anymore. He's an accomplice. What about the watchdogs? Why doesn't someone outside Enron stop this? Rating agencies, Moody's, S&P, Fitch, keep Enron at investment grade. They analyze the company's finances, run their models, talk to management. They see what they want to see. A growth story, a diversified company, strong leadership. What they don't see deeply enough, the off-balance sheet risks, the aggressive assumptions, the lack of actual cash generation. Why not? Because rating agencies are paid by the companies they rate. Enron pays them fees. And if a rating agency gets too skeptical, Enron might take its business elsewhere. Wall Street analysts are the same. They work for banks that earn enormous fees from Enron's complex financial deals. Those banks have lending relationships worth hundreds of millions with Enron. Analysts who rate Enron sell or hold find their access cut off. Analysts who stay bullish get invited to meetings, get information, help their banks win deals. The entire system is designed to perpetuate belief. Not because of a conspiracy. There's no smoke-filled room where everyone agrees to lie. It's simpler and more insidious than that. Everyone has individual incentives that align toward the same outcome. Keep the story going. Michael watches an earnings call where Jeff Skilling confidently answers analyst questions. The Fastow is Bonnery. Numbers Skilling cites are based on models Michael built. Models he knows are built on assumptions that might not survive contact with reality, but Skilling delivers them with absolute certainty. And the analysts nod along. Spring 2001. A major project collapses. Azurix, Enron's water company venture, has failed spectacularly. Hundreds of millions in losses. Internally, there's panic. The loss is too big to hide cleanly. They can't just create another SPE to absorb it without raising red flags. Michael is in a marathon series of meetings. Everyone's exhausted. Someone suggests, what if we accelerate future revenues from other projects? Use mark-to-market more aggressively elsewhere to offset the loss? Another person, we're already stretched thin on assumptions. Then we stretch further. Michael realizes the line has been crossed completely. They're no longer using mark-to-market to reflect reality. They're using it to manufacture reality, to create a fictional world on paper that's increasingly distant from the actual operations of the company. He thinks about speaking up, about saying clearly, "This is fraud." But what would happen? He'd be fired. Maybe worse, he signed documents, he's built models, he's part of this. If he's the whistleblower, he's also a defendant. So he stays quiet and hates himself for it. That night, in his car in the parking lot, he allows himself to imagine the unimaginable. What if Enron collapses? What if the stock goes to zero? What happens to the thousands of employees who believed? He drives home, opens his laptop, looks at his own portfolio. He owns Enron stock too. Not as much as some people, but enough that it matters. He sells it. All of it. The next morning, it's the only decision he'll feel good about in the months to come. Summer 2001, Jeff Skilling abruptly resigns as CEO. Officially, it's for personal reasons. Internally, people whisper he sees the iceberg. August. A vice president named Sherron Watkins writes an anonymous letter to Ken Lay warning that Enron might implode in a wave of accounting scandals. October. Enron reports a $638 million quarterly loss and announces a $1.2 billion reduction in shareholder equity related to SPE transactions. The market panics. The stock price falls from $90 to $60, then to $40, then $20. Michael watches it happen in real time. His phone rings constantly. Auditors, lawyers, investigators. Everyone wants to understand the models, the assumptions, the decisions. He prints out spreadsheets, years of them, sees his own fingerprints all over the illusion. The 8th of November, 2001. Enron admits it overstated earnings by nearly $600 million since 1997. They'll restate 5 years of financial statements. The stock falls to $9. November 28. Credit rating agencies downgrade Enron to junk status. The 2nd of December 2001. Enron files for bankruptcy. At the time, it's the largest bankruptcy in American history. Thousands of employees lose their jobs. Retirement accounts, filled with Enron stock, become worthless. Investors, pension funds, mutual funds, ordinary people lose billions. Michael keeps working through the bankruptcy, helping investigators understand the accounting. He's not high profile enough to be indicted. He's not a hero like Sherron Watkins. He's just a mid-level accountant who did what he was told, who built the models he was asked to build. He's the system working as designed. The trials begin. Ken Lay and Jeff Skilling are indicted for fraud, conspiracy, insider trading. Andrew Fastow, the CFO who ran many of the SPEs, pleads guilty. Arthur Andersen, once one of the Big Five accounting firms, is convicted of obstructing justice for shredding Enron documents. The conviction is later overturned, but it doesn't matter. The firm is already dead. 85,000 people lose their jobs. The media loves the narrative. Greedy executives, corrupt accountants, a company built on lies. There are perp walks, trials on TV. Lay and Skilling are convicted in 2006. Michael watches it all with mixed feelings. Yes, those men made decisions. Yes, they're culpable. But he knows the truth is more diffuse. The lie wasn't just Enron. It was Wall Street analysts who never asked hard questions. It was rating agencies who rubber-stamped the company's debt. It was regulators who approved mark-to-market without understanding how it could be weaponized. It was auditors who collected massive fees and looked the other way. It was accountants like him who knew the models were built on sand, but kept building anyway. The 30th of July, 2002. President Bush signs the Sarbanes-Oxley Act into law. It's the most significant reform of corporate accounting since the 1930 seconds. The law requires CEOs and CFOs to personally certify financial statements, independent audit committees, stronger internal controls, criminal penalties for fraud, protection for whistleblowers, restrictions on auditors providing consulting services to audit. Clients. Michael reads the bill. It's something. Executives will think twice before signing fraudulent statements. Auditors will have more independence. Controls will be tighter. But he also knows what it doesn't fix. It doesn't eliminate mark-to-market accounting. It doesn't change the fundamental incentive structure that rewards short-term stock prices over long-term value creation. It doesn't prevent companies from using complex off-balance sheet structures. They changed the forms. They changed the signatures. They added certifications and controls. But they didn't change the fundamental lie that numbers on a page are always the truth, that models are reality, that risk can be tamed by mathematics. Michael thinks about this a lot in the years after. What was the lie, really? It wasn't just that Enron faked its numbers. Lots of companies have committed accounting fraud. That's not new. The lie was deeper. It was that complexity equals control. That if you use sophisticated enough models, hire smart enough people, get prestigious enough auditors, you're somehow insulated from reality. It was the lie that said, we can measure risk perfectly, predict the future accurately, and turn uncertainty into certainty through mathematical precision. It was the lie that everyone with power wanted to believe, because believing it meant the system could continue as is. The money could keep flowing. The fees could keep accumulating. The bonuses could keep getting paid. Enron was just where the lie became visible, where the gap between the model and reality grew so large it couldn't be hidden anymore. But the lie survived. Michael sees it in the news. Other companies using aggressive accounting. Wall Street banks creating complex derivatives based on models that assume risk is quantifiable. Credit default swaps, collateralized debt obligations, structured finance vehicles, all of it built on the same foundation. He thinks about calling someone, a reporter maybe, telling his story. But what would he say? I helped build the models that destroyed Enron? I knew it was wrong, but did it anyway? The system encouraged me to lie, so I did? All true, none exculpatory. So he stays quiet, changes careers eventually, leaves finance altogether. Gets a job at a small nonprofit doing basic bookkeeping. Numbers that tie out. Reality on paper matching reality in the world. It pays a fraction of what Enron did. He drives a used car. Lives in a modest apartment. But he sleeps better. 5 years after Enron's collapse, Michael watches the financial crisis unfold. 2008. Lehman Brothers, Bear Stearns, AIG, all imploding. The mechanism is different. This time it's mortgage-backed securities, not energy contracts. This time it's housing prices, not gas prices. This time it's credit default swaps, not special purpose entities. But the pattern is identical. Complex models, aggressive assumptions, off-balance sheet, risk, rating agencies blessing it all, auditors not asking hard questions, regulators a step behind. And at the center, mark-to-market accounting, valuing assets based on models of the future rather than reality in the present. Banks holding mortgage securities marked at 100% of face value when the underlying loans are defaulting. Credit derivatives valued at zero risk when they're backed by assets that are plummeting. The same weird math. The same ability to create profit on paper while reality crumbles underneath. Michael isn't surprised. He's heartbroken, but not surprised. Because the lesson from Enron wasn't learned. Or rather, the wrong lesson was learned. The lesson Wall Street learned was, Don't be as obvious as Enron. Be more sophisticated. Spread the risk around so no single company collapses spectacularly. Make the models more complex so they're harder to challenge. The lesson regulators learned was add more rules, more paperwork, more certifications, but don't challenge. The fundamental premise that financial engineering can transmute risk into safety. The lesson no one learned was the one Michael knows in his bones. You cannot model away reality. You cannot write enough rules to prevent people from gaming those rules. You cannot create a system where everyone has an incentive to believe a lie and expect truth to emerge. Today, Michael is 55. He doesn't talk about Enron much. Most people don't ask. His name never appeared in the newspapers. He was never charged with a crime. He's not in the documentaries. But sometimes, when he's reading about whatever the newest financial innovation is, cryptocurrency valuations, private equity accounting, SPACs, AI company projections, he recognizes the pattern. It's always the same pattern. Someone finds a way to book future value today. Someone builds a model that turns uncertainty into a number with false precision. Someone convinces the gatekeepers to sign off. The money flows. The stock rises. Everyone gets rich. Until the future arrives and looks nothing like the model. Michael thinks about the accountants working at those companies right now. Mid-level finance people, building models, making assumptions, signing off on numbers that are technically defensible but fundamentally fictional. He wonders if they feel the same unease he felt. The same quiet knowledge that what they're doing is legal but not honest, approved but not real. He wonders if they'll have the courage he didn't have to say no, to speak up, to refuse. Probably not. The system hasn't changed that much. The incentives are still there. The penalties for dissent are still high. The rewards for compliance are still substantial. And so, the cycle continues. Different names. Different products. Same weird math. Your pension fund. Your index fund. Your 401. It's K. Somewhere in there, buried in hundreds of pages of disclosures and footnotes, an accountant is making assumptions about the future on your behalf. They're estimating cash flows that haven't happened. They're picking discount rates based on models. They're valuing assets that have no real market price. They're turning uncertainty into numbers, futures into present values, risk into reward. Some of those assumptions will be right. Some will be wrong. And the difference between those outcomes could be the difference between retirement security and working until you die. The question isn't whether there's another Enron coming. The question is, which balance sheet is lying to you right now, and whose future is being marked to someone else's market? In a room somewhere, right now, an accountant is staring at a spreadsheet. They're being asked to be reasonable about assumptions, to be a team player about the numbers, to remember that everyone's bonus depends on hitting the target. And they're making the same choice Michael made 25 years ago. They're choosing to believe that if enough smart people sign off on it, if enough regulations are followed, if enough boxes are checked, then the numbers on the page must be true. They're choosing to believe reality is whatever the spreadsheet says. And somewhere, maybe decades from now, they'll sit in an empty office late at night, scrolling through old models, and realize the exact moment when their weird math stopped reflecting the truth and started creating the fiction. The lie that destroyed Enron didn't die with Enron. It's alive. It's in your portfolio. And it's waiting for the next accountant to realize, too late, what they've helped build. History doesn't repeat, but the math does.